Sure.
Yeah,
Okay.
all the everyone's just kind of picky, but that's not the case for your the investors that you could probably find on your own that your friends and family, extensions of that. They don't require that stuff.
Yeah, sure. No, that's
Hmm.
really good. So we should probably start winding this down. We've been talking
Hmm.
for close to an hour now, but let me just ask. I've got two more questions I'm keen to ask you. So the first one would be, are there any traits from your time playing sports earlier on in your life that you believe have helped you succeed as a trader? Any traits that have you've essentially carried over and applied to your trading today?
Yeah, I'd say a couple, one off the field and one on the field. Off the field was the preparation of you know, you prepare to develop confidence. That's how, at least that's how it worked for me. I If I didn't practice and prepare for the game, I was a pitcher, so a baseball pitcher, so I would need to work on my pitches and protect, do my arm, shoulder exercises to keep my arm healthy, and there's my other exercises for my other body to be loose and stretched and strong and everything, so I could be explosive and move freely and things like that. Um, so if I didn't do those things, you know, in between starts, I didn't feel confident and I couldn't execute well on the field. Um, so that was huge for me because I was not a kid that was blessed like with this Superman talent where I could just like roll out of bed and just like kind of do really well. I really needed to do my work and like do all do all the little things that I don't know that help me get on the same playing field as some of like these like superstar athletes or these things. So um, that's what helped me a lot, and I got a lot of joy out of it. I almost enjoyed practice more than the games a lot of the time, um, because it's just that like this is what I got to do. And plus I get to like do it while I was like alone. It was like my little sanctuary. I was in the zone and just preparing for the game and visualizing kicking ass on the field when the game time came. So I don't know. I liked all those things. That's probably why I got into this. Why trend following, why systematic approach appeals to me because you get to prepare. You know, you get to do all the little things, and like the training is kind of just like pretty easy. It's not a lot of work. It's the practice time and the preparation time is the work. So I don't. I think also on the field, when the game time came, you have the confidence, everything, and you're playing. Sometimes you get in situations that are you have some pressure. You have the game's on the line. You have a big spot in the game where you know it's it's a make or break. In my case, like a pitch where it can mean the difference between getting out of the inning or losing the game or falling behind. So was weird, and what I still feel today is that I can deal with pressure very well because I know I've done the work. So if I know, I just keep doing the work, and I know I do what I'm supposed to do, that there really is no pressure. The pressure is really just I feel like when I feel pressure is when I feel like I'm unprepared, and I used to feel that way sometimes in school when I didn't study for a test as much as I should have, or something like that, or making a presentation, which like doing a project that I didn't do as well on, or I didn't prepare as well on. That's when I would feel my heart rate would go up. I get that anxiety, like those rushes through like I get in like my chest, but I get those feelings that's like, oh my God, I don't know what I'm doing. Like I'm not as good. And then my delivery, like my test taking, I'm nervous, I'm not thinking clearly and smoothly and slowly. And same thing on the field. Like the game's moving fast. I'm not as calm, so I can't execute my move, my pitching motion, as fluid and as explosive as it needs to be in order to execute the pitch well. If you're jittery and your hands are shaking and you're not as sturdy on your feet and your mind's racing because you're now aware that you didn't prepare, so your mind is screwed too. So I think that happens in trading as well. That's when people jump off their systems and jump off their approach. It's likely due to a preparation issue, maybe, or they don't really have a style that they're committed to. They have kind of a style, but they don't have a really rock solid foundation and approach for what they're doing. They're kind of just on the whim, kind of just making it up as they go along, and they're winging it. Like in my test taking, I used to maybe some of your viewers have the same experience too. They just didn't study or something. They come into test and they're all anxious and they're, I'm just winging it. I'm just, whatever. I think I know it okay, but, they definitely usually don't know it on average. They don't know it as well as if they, took the time to study for it and prepare for it. So, yeah.
Absolutely. Yeah, I really like how you highlighted the need for preparation there. I think that's solid. And I mean, in that answer, you pretty much covered the second question I was going to ask here, which was going to be around what a quote I've heard you say in the past is people know what to do, but they just don't do it. And I mean, you kind of covered it there as a lack of preparation. And
yeah, and I think that's something that the best traders do really well. They know what their style is. They know what they like about their style, what they don't like about the style. There's some things about trend following I just don't like. But I know I can't have it all. I can't have everything. It's unnatural to have everything. And if you want to have everything, just go observe the star systems out there in the universe. They want to have it all for them. And what happens? They collapse into a black hole and they die. So I feel that you're gonna have to give some things up in order to do your style well. In trading, in trend following, you're giving up the need to catch every little wiggle and move out there. You're giving up the need to even understand what the markets are doing. You forget that with trend following. You're kind of just, I don't really know why this thing is moving that well, but I'm in it and I'm long. I'm in it. I'm riding the trend, and I gotta stick with this because that's my system. I need to ride trends, so I can't afford to not be in this one just because I don't understand it. That's kind of one of the most, I don't know, maybe one of the bigger issues people have with it is that, how can you not know what's going on? What are you talking about? How can you be long a thing and not understand why it's moving? And that's like, how do you answer that? To an investor or someone that is come up with in a career that it's built on understanding things, and a lot of trend followers just don't care about that. And doesn't mean they can't make money, because obviously they've shown there's a history of them doing really well. But it's something that someone who doesn't like to feel that won't be able to be a trend follower then. Sorry, you just won't be able to do it, because you commit that in your style as to not understanding. So you just need to be okay with what your style is and what the quote unquote good and bad of it is. What you like and what you don't like, and that helps you, I think, create a style that you can execute like a Navy SEAL every day. Like you could be able to do it and do it well, and not apologize for, I don't understand it either, but this is my style to do it, and I'm doing it regardless. This is, I know what I have to do. So, I feel, getting and being in touch with at least the things that you like and don't like, you can create a better strategy for yourself that you're going to be able to execute well. And then when you can do that, you'll probably you'll stand to do a lot better over the course of your career with trading.
Yeah, no doubt. So, well, Mike, we should probably wind this down now, but I mean, thank you very much for coming on. It's been really great to have you share these lessons and experiences and what you've discovered for yourself in the markets, because I think it's going to be interesting for listeners because you're coming at it from a different angle than what many of the guests which we've had on in the past. So it's good to have a bit of variety in the mix. So I really appreciate it, man.
Sure. Yeah.
Do you want to share with listeners where they can go to find out more about you?
Sure. I mean, I have my firm's trading site is Melicinos Trading. I think will you have it in the show notes, something, because of my name may be a little bit difficult
absolutely. Absolutely. So if anyone wants to check out Michael's site and a bunch of other links and any of the resources that we've talked about in this interview, including Ed's site, I'll link to that also.
Yeah.
So they'll all be at chatwithtraders.com/34. Everything will be there in the show notes. So I'll link to your website in there. So definitely, I suggest everyone goes over there, checks it out. Are you on Twitter also?
Yep. Not very active on it, but
okay.
I'm on it. It's just it's M Melicinos. Again, I would put that in the show notes because I'm sorry, my name is Greek and it's kind of tough, but it spells like Melissa. So it's just MELISSINOS.
Got it. Yeah, no doubt. I'll link to that in the show notes also. Because I know many of the listeners are quite active on Twitter, so I'm sure they'd like to check you out there. But
for a long-term systematic trend follower, Twitter, other than maybe posting some maybe more deeper, long form type of content, being on there, like the stock twits guys, like you'll never see like a long-term trend follow on there because he doesn't really, he's not doing much. He's not doing as much as some of those other more active guys. So I know Twitter's good. I know Twitter's good for that, but for me and my style, no. But I should be posting more informational stuff on there though. I think who does that well is Jerry Parker. He was one of the turtles that Covell highlighted in his book many times. He's been on his podcast a few times. He's good, and he's been around a long time. He's probably a billionaire trend follower turtle, probably the most successful turtle. But he does that well on Twitter. Go check him out.
For sure. Okay, no, that's really good. Again, Michael, thank you very much for doing this. We'll call it a wrap, and let's talk soon.
You got it.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality executed with for those ready to build strategy selection and clearing fees for FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey everyone, what's going on? Welcome to episode 35 of the Chat with Traders podcast. This week I have a very special guest on the show who almost needs no introduction, and that is Howard Lindzon. He's best known as the co-founder of StockTwits, but he's really a man who wears many hats. He's also a trader, investor, hedge fund manager, entrepreneur, and a rockstar angel investor who has invested in over 100 startups at various stages. So, as you could imagine, I was thrilled to have Howard on the show this week. We spoke for around about 50 minutes and discussed the early years of his career, from the days of when he used to work in the back office of a brokerage firm. We also covered Howard's methodology around trading high growth stocks and the idea of buy high, sell higher. We also got into how innovative technology may revolutionize the landscape of trading over the next 5 to 10 years. And on top of this, we also talked about some of the angel investments that Howard has been involved with. Now, guys, if you enjoyed this interview, please go to chatwithtraders.com/iTunes and leave a review. It doesn't have to be anything crazy. Even a single sentence would be a huge help. I'd really appreciate it, and it's the easiest way that you can support this show. So that's chatwithtraders.com/iTunes. Go there now and just leave a very brief review. That would be awesome. Thank you very much. All right, guys, I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is this week's guest, Howard Lindzon. Howard, welcome to the podcast. How's it going?
I am doing great. I am in San Diego. It's the opposite side of the world.
It most definitely is. So it's early morning here, and I believe it's becoming afternoon there. So look, Howard, thank you so much for giving up your time today to speak with me, and just share your insights and experiences with everyone who's listening. I've really been looking forward to this. It's going to be a great discussion. So again, thank you very much.
No problem.
I'm thinking we'll break this discussion up into a few parts. So we'll talk about some trading specifics. That'll probably lead us into some discussion about trend and momentum. Also keen to speak with you about technology, innovation, and some of the angel investing work that you do. So before we get into all of that though, I'm keen to hear about your background and where it all started for you. So once you graduated from high school, what was the next step from there? Maybe take us through to the point of just before you launched your hedge fund.
Oh, after high school, I worked in the. I went to college in London, Ontario. Nothing fancy. And then when I graduated, '87, I didn't have a job. Didn't know what I wanted to do. Go to school much younger in Toronto, a year younger. And I went to work in the stock market at a brokerage firm in Toronto. Right before the peak, I was working in the back office. Order tickets would come in on a machine, like a little air terminal. The ticket would come in, you type it in the machine, it would go down to the floor, you'd get a confirmation. That's how archaic it was back in '87, which I'm sure seemed unbelievably like great progress compared to 20 years earlier. Now, basically, you can click a button on Robinhood, which is now even in Australia, and trade for free right from your mobile phone. But back then, it was, a process. I worked in the wire room, knew not much about the stock market. I was probably 21. And in October '87, the market crashed, and I just never forget where you were, especially since I was in the industry. And, people banging on the door, orders piling up. I was the guy. People were screaming through the window. I was the guy trying to type orders in frantically, and I didn't even know what was really happening at the time. Other than I could tell it was something major. And the firm that I worked at shut down. They had a huge position in gold, as most Canadians, like Australia, is a mining based and a manufacturing base in countries. And there was a heavy duty recession. The brokerage industry was buried in margin and no business for months after, and the gold stocks were hammered. So that was my introduction to stock markets.
Okay, and was that always your goal from right back in high school to once you got out to go into the stock market, or was it just you just kind of wound up there by a bit of luck?
I just wanted a job. My dad was a a trader, an investor, but I didn't have an interest in it. So, I was just looking for a job. I went back to school after the market crash in '87. There were no jobs, and moved to Arizona. Went to school at ASU, became a desert kind of rat, graduated, and as luck would have it, or fate, I ended up, because I was a Canadian citizen looking for a job, I ended up having to take an ad in the paper and just became a stockbroker. It was the only company that was willing to sponsor me to stay in the United States was to be a stockbroker. And so I became a stockbroker knowing nothing about the stock market still.
Okay, and is that the point where your interest was peaked and you developed the fascination for trading, or did that still come a little bit later?
Oh, much later. So, back then you couldn't think. You were just had to learn the market, pass your exam. It was 91 after the Gulf War. Stocks were savaged. I didn't even know any of this. So it was a great time to be getting into the stock market. And it was the end of the S&L crisis in Arizona. It was all kinds of savings and banks. The banks were destroyed, much like 2008, and because of the savings and loan crisis. And so it just turned out to be a great point. I didn't know what I was doing. I was just trying to sell what the firm had. It was a pretty good firm. We weren't selling penny stocks or anything. I mean, I had my list of stuff I would call cold call. It was back then you would do cold calls. And so slowly that's how I started to learn the market. I had no mentors other than from a sales perspective. I was taught how to sell. So I tried to keep it simple, but over time I just became fascinated with stocks and prices, and it took me probably maybe 87, 91. It was 24 years later, I've learned a thing or two.
Okay, sure. No, that's awesome. So between being a stockbroker and launching your hedge fund, what went on in that period? How did you make that transition?
You start meeting people, get a little older. I was fascinated with the market slowly over time. People had started to trust me, and it was a bull market, so everybody thinks they can do it in the mid-'90s to the late '90s. So I think a combination of all those factors, plus knowing a lot of successful people, I decided to strike out on my own and start a hedge fund, knowing nothing about it. And in '98, when you started a hedge fund, you were theoretically at the top of the market. Flash forward 17 years, hedge funds are more popular than ever, even though they've been supposed to have been dead for the last 20 years. So the lesson there being it's never too late to start a business, no matter what the category is. You gotta love what you're doing and be able to ride the ups and downs. And so the same thing applies to every aspect of working or entrepreneurship. Or what I talk to my kids about is I remember starting that hedge fund and people going, nah, who doesn't have a hedge fund? And this was in '98, during the Kramer Street.com passionate era of blogging and writing, or the Street.com at least was blogging, and Jim Kramer was like, oh, of course you're starting a hedge fund, who wouldn't? And I've been running that hedge fund for 17 years now, and it's turned it into a big business, a small business, because I'm too busy. And my passion has been more about private company investing, not so much trading other people's money. So my main passion is investing my own money and investing in startups. But that's how it's evolved. But I still have that hedge fund 17 years later.
Absolutely, and I'm really keen to get into those two things you just mentioned there. Just while we're on the hedge fund topic, did you have any experience actually trading your own money before you went into launching the hedge fund?
Yeah. My parents divorced. My mom had no idea. She had a little bit of money. I was 19, so I was stuck. That was my original. I think I've written something about this way back, but the thesis being, your original exposure to risk and management, really shapes your risk profile later on. So when I had to take over my mom's account, I couldn't risk losing $1. And it's kind of the same unfortunate or fortunate way that I look at The same unfortunate way or fortunate way I say I look at how I deal with other people's money today is that where I struggled in the stock market was I couldn't afford to lose money. So it's not a great place to be if you can't take risk. And so my strategy has always been a little bit more conservative. Over time, I've developed a much more aggressive strategy around momentum, and things in motion tend to stay in motion, but definitely not good for my mom, or it's definitely good for my money because I feel comfortable with it, but I don't like managing that strategy for other people's money, which is why my hedge fund doesn't take new money and why I focused on private companies, because I'm all about a momentum if my investors understand that they could lose all their money. And that's the way when you invest in an angel fund, which we've started through social leverage, my investors expect me to take big risk on big trends, and bad things could happen. So, it's in managing the expectations of my clients and my own lifestyle and risk profile. That's how over 17 years you end up with, evolving your thesis and your product so that my risk profile fits the risk profile of my investors.
Absolutely. Okay. No, that's really well said. Now, this is a question I usually ask to guests on the show, and I usually ask them what were some of their biggest challenges as a developing trader. But in your case, let's open this up. So, what were some of your greatest challenges or failures in your early years as a trader slash entrepreneur slash investor?
Well, I think, like I said, the structure of my life around risk, because I had some of my mom's money that she couldn't afford to lose. I knew it had to last. She's still alive today, so that's 30 years later. I was 19, 29, 39, 40. I'm 49, so 30 years later of managing her small nest egg, I've had to, knowing that I'd have to support whatever difference there was, assuming she lived till 100. So I've always been, that's where my risk profile was structured, for good or bad. Mistake-wise, in starting a hedge fund, I made so many. I mean, obviously, starting it in June '98, the Asia crisis happened right after the 2000 crash in 2008. So, plenty of mistakes. Most of my mistakes more have been about people than about stocks. I'm pretty good at taking losses. I've learned to not listen to the TV, and I read people that think like me, not because I want to form fit my ideas, but just strategically wise, I try and just focus on my strategy so I don't bring in outside noise. So all those mistakes that people continue to make about trying to just have too many styles or survive in every single market. I'm not survive so much, but thrive in every single tick of the market. Once I settled on my style and communicated well with my limited partners and my clients, and they understood what I was doing, they never had to bug me, and I never had to worry about what they were thinking because they knew what I was doing. I think most investors just try to make money all the time, it seems like, and it's hard not to, because the market is just right there for us every day, all day. And I think the great investors will tell you, it's a lifelong process, but the great investors will tell you that they just don't trade that much. Most of the time you're just sitting. So, that's by sitting has allowed my life to expand and my portfolio to expand, because by sitting you have a lot more time to look at more things and really kind of the good pitches you're just more aware of instead of just hacking away every day at the market.
Okay, so let's dig into your strategy then. How would you best describe your approach to trading? From what I understand, you're both into trend following as well as momentum trading. So would you like to elaborate on your actual methodology for trading?
Yeah, nothing fancy. I mean, the basic example is buy high, sell higher. An IBD philosophy, or Bill O'Neill, is that stocks in motion tend to stay in motion. And I'm small enough that I've just kind of evolved my strategy to think like a pilot fish. Sharks are out there moving the waters, and I'm just riding there with them as long as I can, and have a pretty good sell discipline. I would say every time I make a mistake, it's generally around selling, not buying. And in the private market, it's a little different. because you're not liquid. So in the public markets, I like to swim in the most liquid markets because you can change your mind very quickly. There's liquidity, and then in the private markets where things are illiquid, it's still a very much a momentum-based strategy around trends and applying them to private industries, but a little more sensitive, obviously, to price early on because they are illiquid.
Absolutely. So just talking about the public markets still, what are some guidelines or perhaps common characteristics to discovering the big market-winning trends before they actually happen?
Well, they tend to happen in consumer stocks, whether it's restaurants, fashion, or consumer brands like Apple. They generally are they're brands that you're already using. One of the best stocks of all times is Philip Morris. So I would say it's still a consumer brand. It's a SIN stock as well. And 99% of us have never owned it unless it's been in an ETF of ours for as good a stock as it's been. So, they're generally brands that you've heard of, shockingly, whether it's Nike, Under Armour, Apple, Google. I consider all these consumer stocks, not technology stocks, because we use their products every day. Chipotle's, and these are right in front of us most of the time. And then generally they stay overvalued for extremely, 5 to 10 year periods. Some of them longer, but generally, I can hold stocks 3 to 5 years. That makes my job easier. It doesn't always happen that way, but I'm looking for things that just are part of bigger consumer trends.
Okay, and you mentioned a little bit earlier that you like to buy high and sell higher. So you're looking at stocks that are breaking into all-time highs, and I've just got 2 questions around that. What is it you like about stocks that break into all-time highs? Like, why is that a good thing? And do you also pay attention to perhaps shorting opportunities that occur from stocks breaking down into all-time lows?
Yeah, I would think that, definitely on all-time lows, there's a strategy that works, but mathematically, over all the money that I've ever wasted learning and spending on shorting stocks and looking at the Fortune 500 list, I don't know anybody who really is, if I were to look at Buffett and some of the best investors, they don't short stocks. They ignore them and they use cash. And so no, shorting is just like, I'll talk about it occasionally. I have this feeling about the market, but I'm never right because the math is stacked against you generally. And so no, shorting is generally out. And then all-time highs is just something that works for me. It's counterintuitive. Most people ignore this, even though there's so much data available on how the strategy works. Nobody cares. God forbid you tell somebody momentum, their heart seizes and their ears close, and they think it's voodoo. And I like knowing that. I mean, if everybody did it, it wouldn't be as easy. And investing is hard. Buying high, selling higher means that you are buying stocks that are obviously discovered because people own them. But at the same time, they also are highly shorted because the professionals, love to hedge and love to bet against companies to get paid their 2 and 20. And, historically, stocks that are at all-time highs got there for a reason. They were on an all-time high list the day before, a week before, a month before. So great companies growing really fast with catalysts tend to make hundreds of all-time highs. And so it just makes common sense to me as a small investor to follow those type of trends. It's not for everybody, right? Like, it's not for everybody. It's just, I like to keep things really simple. And if I buy a stock at an all-time high, it means there's no resistance. Everybody who owns the stock is profitable. Everybody who's short the stock is freaking out, and that's potential buyers. And it's, and then when I can combine it with a catalyst like, oh my God, this is a product that's being underrated or undervalued, or really simple stuff like, oh my God, this company, when it was Apple, it was like, fuck, there were 60 stores. I'm like, I could see 60 stores just in China. And this is like 8 years ago. So, buying it when it was 60 stores just in the United States seemed like just a simple, good idea. And the stock was, had been at all-time highs for 3-4 years already by 2006. So, in hindsight, it doesn't look that crazy. Same with Chipotle's when they went public. What were they, a couple hundred stores? And yes, McDonald's was selling their shares, but in the end, that it was just early in the growth process. And Wall Street likes growth. Like in the end, try not to overthink it. Wall Street still pays up for growth, historically and always.
Okay, so once a stock's broken through to all-time highs, there's no previous highs that might act as resistance. What are perhaps some warning signs or red flags that you watch for, which may indicate that a trend is nearing an end?
Yeah, it's a good question. A lot of it is just feel. A lot of it is trial and error. A lot of it is your own risk preference. I can sell on the way up. I generally sell on the way up. So, I leave tons of money on the table. The greatest trader is pyramid in. I'm pyramiding out. So, but again, that goes back to my risk profile. And the fear of losing money is greater than my joy of making tons of money. And that's, you got to live with what you got. And you can't, just live within those means. But the signs are generally, sometimes you never get a warning. So just blindly buying all-time highs is not, a perfect strategy. And sometimes, I get the catalyst wrong and stocks implode without much warning. But most of the time, stocks give you a few warnings in price and volume. They give you warnings around an earnings. And sometimes you get one warning and the trend is over. And sometimes, it's a fake warning. But, you just have to have your money management skills. Some people, have 10% drawdown rules. Some people have 15%. I'm more, a blended... if I really believe in the trend and the market's strong, I may give a stock more room. Just depends. There's not one style fits all. And I'm very unscientific. Ivan, who trades for me and is a young guy, Ivanoff, who, works for me, has his own style that he deploys on top of my style. But generally, right now I'm long a couple stocks that I don't fully have the full thesis on, but I use their products and I'm bullish on them, Chegg and Lulu. So those are two new additions that, they're not at all-time highs. They're very strong right now in a tough tape. And I understand what I think are the catalysts. I think one is, evolving into a huge learning platform, and the other, Lulu, is products that I use all the time. And so I think both are trends that, while the stocks aren't at all-time highs, I break my rules all the time for stocks in good uptrends, but, aren't quite at all-time highs. And then Nike and Under Armour, I've been long for, on and off for 5-6 years, mostly on, where, the stocks have been at around all-time highs for most of the last 5 years.
Okay, sure.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Now, this is something I've heard you say a few times in the past, and that is there are no experts. So I'm interested to know what makes you actually say this.
Well, the market's the expert, so the market decides. You can fight the market and get run over, or you can be the market like Goldman or Warren Buffett. They basically are big enough. They are the market and they make the market. But if you're not making the market, you have to respect it. And so I don't listen to anybody except the price and volume and my own instincts around catalysts, the products themselves. So, Wall Street's all about, oh, this guy said this and that guy said that, and the CEO said this. And I'm more about what are the consumers doing with those products, and being more in tune at the street level with what's happening. And then if the price and volume confirms what I'm thinking, I'm like, I love that. And I don't care what anybody's saying because there are no experts because the market has decided what the price and the volume is.
Yeah, I really like that quote because, as a young trader and someone who's coming up, it can be very easy for them to be influenced.
Well, you need mentors. So, if I can be a mentor to people, but you have to listen to me for hours to find two nuggets, I guess, because I'm, rambling on. But, I didn't have great mentors. So, the young people today have great, like I said, I was a stockbroker and they just threw me in a room with fill a binder full of Blockbuster and Compaq and the shit that we're selling and go sell that. It wasn't like I had time to learn the intricacies of the market. Now you can go on StockTwits and find 200 people that are expert in one specific subject. And you can get right to learning anywhere on the web much quicker, and you can trade for free. So, if I had only known, so, at StockTwits and anything that we're focused on in Robinhood, which we're investors in, we're focused on helping people, onboard and learn the language of the markets much quicker. That's all we can do. That's all we can do is give people the tools to learn quicker, but not tell them we're the experts or, we're not selling anything other than the magic of, oh my God, the markets are awesome. It's like learning Spanish takes a while and you're better to immerse yourself into it and you're going to make mistakes and you're going to offend people and you're going to, that's the market.
Of course, yeah. So while you mentioned StockTwits there, I'm sure you get asked this all the time, but what actually sparked the idea for StockTwits? Did you see a genuine need for a service like this at the time?
Yeah, I don't use Bloomberg, don't read Wall Street Journal, don't watch CNBC. I was reading some blogs of venture capitalists really discovering trend following, and I was a Momentum IBD guy, so reading Investors Business Daily every day or on the weekend. And Twitter started, and I had an opportunity to invest early, and I was using Twitter, and I was like, oh my God, Twitter for stocks would be amazing. This was 2007. And I emailed Fred Wilson, who was one of the biggest investor in Twitter, a friend of mine, and said Twitter for stocks would be incredible. Why don't they do this? And he said, why don't you start it? And so I kind of got, dared into starting StockTwits, which was originally built on the Twitter platform, just, figuring Twitter would just incorporate it and either acquire it or partner and I would just help curate the financial section of it, like a financial part of Twitter, which in hindsight, that's what, I think the best part of Twitter still is. And then slowly StockTwits has built its own platform that doesn't rely on Twitter, but uses Twitter to get leads and find smart people. And StockTwits is its own self-reliant ecosystem of traders and investors. So really started out as just an idea to work on top of Twitter, but Twitter had its limitations, and we wanted to build a community just for traders, and that's how StockTwits started. So it's been almost 7 years.
For sure. And a lot of listeners, I'm sure, are active users on StockTwits. What's the advantage to these traders who use StockTwits, particularly the newer traders who are using this platform? Like, how can they get the most out of it?
Well, it's different strokes for different folks. If I could explain it, we'd only be 100 people because they would all think like me. God, it's so big that I don't even know all the different reasons people use it. But for me, I'm mainly on the mobile app these days. So all I think about is mobile because I'm on the road, and I've always wanted a product that allows me to catch up on my watch list really quickly, and have the key people that I know follow that stock to be able to talk to quickly if I need something. And then on a bigger picture, who are the 8 or 10 people that Global Macro look down and can give me, end of day kind of readings in 5 minutes? How do I catch up on the market really fast from my iPhone? That was always the goal. And we're finally getting there with our latest apps. And on the website, there's a million ways to use the product. You can start by searching by tickers. You can follow me and say hello. Just to be able to access some of the greatest traders who are doing it for their own reasons, most of the time just to journal and keep themselves accountable and to their own money. I think what people misunderstand is the reason people use StockTwits, the good ones, or at least why I use it, is just to write my own ideas down so that I can be called out on it. And I don't want to tell people what to do. I just want to write down what I do. And I think that's the big difference of StockTwits, I hope, over old media, which was everything pre-Twitter, and including Twitter, unfortunately, where there's so much spam and penny stock chatter. But the idea for me is, here's what I'm doing. Tell me why I'm crazy. And you don't have to do it, but I'm just journaling what I'm doing, and then updating it.
Yeah, I like that answer, and I like how you mentioned access in there. I think that's a really valuable feature of StockTwits, is being able to access other great traders and network with others who are maybe more advanced.
It's just finding mentors, networking, saying hello, being if you're not nice, you're generally going to be angry and confrontational. You're not going to last but an hour on StockTwits. We've built a culture which is like, hey man, like you can hang out and take all my ideas and question me all you want, but don't call names and don't attack. And that's been a hard kind of culture to build, but I think we've succeeded. That may not be $1 billion idea, but it's definitely something we're proud of.
Yeah, I'm sure. It's helping a lot of people, so that's a good thing. Now let's move this discussion along a little bit to talk about some technology and innovation that you've seen coming through in this space. So, in the past, you've said there's never been a better time to start a business than there is right now. Would you say that's perhaps the same? Would you say the same applies to traders of today?
It was very one way. Like you read a research report written by some dude or some lady. And now, I don't know why the only reason I read people here is because they show up every day and they're willing to be yelled at if they're wrong or laughed at. Not that you should yell or laugh at them, but like, man, were people here pouring their ideas out and are accountable, and 7 years later still doing it. So I think the difference is, the hierarchy has changed. Back then you had to have a title, you had to have this pulpit, and you had to earn your way into that. And then once you were on it, it was hard to kick you off, even if you sucked. Now it's like, fuck, if you don't have the game, you're not going to last an hour on StockTwits. And if you do have the game, you're going to be revered, but you're only as good as your last, 6 months. So if you're gonna, you just have to consistently share and journal and contribute. Otherwise, you're not going to make it. And that's kind of the market, right? If you really want to be around forever, you got to love doing it, and you got to love sharing, and you got to be wrong all the time. Sometimes as much as 60% of the time. Who the hell wants to do that other than baseball players? Baseball players are the only other people who are like 300. You're hitting 300, you're a fucking all-star. The other time, 70% of the time, they're walking back to the dugout with their fucking, head in their ass. Right? And they're like, still come out, like knowing that 70% of the time they're going to look like an idiot chasing a pitch or grounding out weakly to the shortstop. And that's kind of the market.
Yeah, you've definitely got to get comfortable with losing.
Yeah.
That's for sure. There's no way around that.
Yeah.
What changes do you anticipate coming to the trading landscape over the next, say, 5 to 10 years, particularly in the retail space?
Well, I think we get more of the same. It's obviously mobile. You're going to have to consume these products in mobile. So we're going to see with the beginning of like mobile trading, a pure mobile, like a Robinhood and the ensuing knockoffs and copycats and lookalikes. People are going to be able to open an account in 2 minutes. They're going to be able to follow smart people. They're going to be able to execute a trade for free. They're going to be able to follow mentors. And they're going to be able to do all this from a link on a mobile phone. That's pretty revolutionary. I don't know if we could ask for much more. But it took 20 years for us to go from 1991, which was the beginning of 2001, which was the end of the last bubble, to where we are today, which was when E-Trade and TD Ameritrade and Schwab were in their heydays and coming to the end of, the e-brokerage. And now we're finally having some innovation in mobile brokerage, which is like a whole new generation of millennials globally who either are going to inherit money or have their first job and, may not want to just dollar cost average, which has been droned into their heads for the last 10 years. They may actually want to buy the stock of Facebook or Twitter or GoPro or Shake Shack, to use U.S. stock examples. And, they don't trust E-Trade, Schwab, Goldman Sachs, Bloomberg. They don't even know about them. The last time they heard about them was Jon Stewart making fun of them. And, so they download an app on their phone and they discover investing for their first time, and they can do it with $2,000, and they can buy 10 shares of Facebook dollars for zero commission. If it goes to 95 the next day, they made $50. They don't have to owe 30 of that in commission. And they just basically paper traded with real money and had a great experience. That's much like what Uber did to the old taxi industry. So I think we're at a renaissance point for people to do it themselves. And that's great for global markets, especially with startups at all-time highs. So it's just this massive opportunity. And so for the young people that are learning how to do this, they're just going to have a lifetime of investing ahead of them. So it's an exciting time. I sound like some kind of cheerleader, but I mean, it's so obvious. This trend is so obvious.
Yeah, there's definitely a big shift coming through. So no, that's really good to get your take on it. Now let's shift this along to the last part of this interview, and I'm keen to ask you about your angel investing and experiences you've had around that. So, I mean, at what point of your career did you begin getting into angel investing? And maybe also if you could share with us why you got into this, like what motivated you to go in this direction?
My first angel investment was a cold call that I made as a stockbroker. 92 maybe, I was just calling, dialing for dollars. And, we would open up the newspaper in Phoenix, the Business Journal, and I would just call people that I thought were rich, that were written about, and then pitch them on opening a stock market account. And one of the guys that I called, Mark Scatterday, was just a great guy, ended up investing in his company. I go down to pitch him to open a stock account thinking that he was rich and he needed money he was raising money for his company. And he talked me into investing in it. And that's how I got going on angel investing. And it just turned out to be a great investment. But it wasn't easy. I mean, it sucked up 5-6 years of my life, and we made tons and tons of money, and we had one of the great consumer products. But so, I got into angel investing by mistake. but the passion was there. I had the education, I had the will, I had I love to sell, and I love cool products, and that's how I got the bug. And then I just kept writing checks. I was kind of a sucker for a good pitch. And over 20 years, 92 was my first investment. 23 years of angel investing, I figured I know a little bit now.
No doubt. So what is it that actually attracts you to mostly tech investments over other industries?
I like consumer products, so I would say tech applies to everything now. So I'm more consumer focused. Consumer, it's just interesting to me because it could become a $1 billion company. I mean, it's harder to build, but why not build something that could change the world? And so I would say it's more consumer, but technology just is such a bigger factor in every company right now because of scale and costs of starting these businesses and using Amazon Web Services and having a laptop and an iPhone or a Droid. Everything's technology. And so if you don't know how to use these tools, you're just going to have a small local business. But now any small local business can be a global business. So consumer is number one. The main thing that attracts me is stuff that I'm passionate about. Like, why just money is a commodity, and I'm not rich enough to just throw it around. So I generally like to invest in companies that I either discover myself or that fit into my thesis around financial technology and financial web, which led me to Robinhood and my whole thesis and stock twits. But I invest in great founders who have this insane passion around a problem that they're generally solving for themselves because they have this huge interest and something's bothering them. But then those interests generally end up having a huge audience. And I've invested in a few billion-dollar companies at the beginning to know that a lot of times you just could not imagine them being almost every time they don't start out as billion-dollar ideas, but they're kind of unicorn founders. They throw around the word unicorn a lot, but generally it's the founder that's the unicorn. It's just someone who's willing to fight and scrap and pivot and change their product and get shat on and yelled at and been told their product sucks, but really know that they're solving a problem that then 10,000 people start using, and then once it's at 10,000 people, how do you get it to 100,000? And that's where the technology applies. And then how do you get it from 100 to 1,000,000? So they're all different stages. I like to find the companies that have great founders. There's a clear path, a hypothesis to get to 10,000 type customers or users. And that already have one passionate user, whether they're paying or not, or two. And that's kind of where we invest. And, as I get older, I move a little bit further up the food chain because I'm just old and not willing to do as much of the little bit of work. But hopefully that gives you a little bit of insight.
Yeah, absolutely. So just one more question around that. Now that you've invested in like 100 plus startups and companies all at various stages, I'm sure there's a few deals that you've turned down at the time and you later kick yourself for. Are you able to share an example of maybe one or two deals that you've let go, which you maybe wish you hadn't of?
Yeah, different reasons. So Zynga I passed on. I knew Mark Pincus. I really had agreed to invest in the deal. We were having a argument over another company that we had invested in, and Buddy Media, which turned out to be like a huge company. But I had brought Mark into that deal, and he didn't like the way it was going and was complaining and came up with his idea for Zynga, and I agreed to invest. We had agreed on a price, and that price quickly changed to a number that I wasn't willing to invest in a few months later. And so I just on principle didn't invest, and I should have invested. I think 100 grand would be worth 10 million. And so that's a bad one. The lesson there is even if the founder wants to be a billionaire and you have a chance to invest with them and they're willing to do what it takes to be a billionaire, you're pretty silly not to invest in them. And I think that's why people just continue to give Warren Buffett money at a premium, is the guy is just like, until he drops, he's going to try and beat the market. Second is Twitter. I mean, I love the product. I thought the price was overvalued. That was dumb. At 20 million, I think. I thought, what? You're crazy. $20 million? How could I possibly make money? Whoops. That would be a big one. Probably the biggest mistake because I liked the product. And then one that I just didn't put enough work into was Hotels Tonight. I just didn't know the travel business, and I got pitched that very early, probably like a 2 million valuation. It's kind of like Uber for hotels, or it's like a very last minute hotel booking site using mobile. And I think it's my favorite product. I travel a lot. I don't have to book a hotel. I can just show up and land, and it's location based. Anyway, so I use that app, and every time I use the app, I'm like, should have invested. So that one hurts the most because I love the app, and it's going to be around until it gets acquired for a big number. Zynga, I never was like a fan of the product, so that's just money. And Twitter is just a complete mistake, but I can live with it because I have a lot of shares that I got from investing around the space and StockTwits, and ended up with shares in Twitter because I invested in TweetDeck. So Twitter I got right for enough that it doesn't hurt as much. But I would say Zynga just because of the stupidity of price and just being stubborn. And then Hotels Tonight just because I just didn't see it, but I was offered it.
Yeah, I mean that's some hard lessons in there, and I mean it's really interesting to hear you talk about that. Thank you for sharing those. Now, Howard, this has been really, really good. I've just got one more question, and then we'll call it a wrap. And this question I like to ask to majority of the guests, and it kind of circles back to trading now. But why do you believe the majority of traders never reach a high level of success?
Well, I think they just don't have the mentorship, and they just give up. It's a long process. I just think they have a really bad experience, and it's not for everybody. Investing is a privilege, not a right. So maybe it's good that happens. But I think most people give up because they can't find a mentor, or the barriers. What the media drums on people is, you can't beat the market. And I agree, it's not easy to beat the market, and I don't even think beating the market should be in the vocabulary. It should be about destroying. If you're going to do this, why would I do it to earn 12% a year when the S&P is 9% a year? I do it because I want to have 80% years and 100% years or more. And therefore, if that was easy, so most people just give up because they have the wrong expectations. And they started for the wrong reasons. So that's the main reason people give up. I can't help those people. But if you have the right expectations when you're starting, I would say that's the greatest, hindrance is people just have the wrong framework for getting started. And both are we solve all those, right? Podcasts, I'm telling people the truth from my own experiences. This wasn't as easily accessible in 1990 when I started. And now there's no excuse not to dig into a few podcasts or try a few financial sites and see if you can find a mentor. And then expectation-wise, the same thing. It's I would say to anybody started, what is your expectation? Well, I just want to earn more than cash. Well, you should dollar cost average. That's not, that person should be dollar cost averaging and do, low cost ETFs. But if a person says, I think I can make 80% a year, well, then I say, well, listen, expect to have years where you're down 40%. But if you're willing to ride that out, then you should dig in and start learning and finding a strategy that fits that risk profile.
Totally. All right, Howard. Well, where can listeners go to connect with you and just generally find out more about you?
Easy to find me all day on StockTwits, Zyn.com.
That sort of thing that we've discussed during this discussion. So, Howard, thank you so much for doing this. I really appreciate you taking the time out of your day and sharing, being so open with us in your answers. It's been phenomenal.
Okay, cool. Congrats on doing 35 shows. It's not easy.
Thank you very much. All right, Howard, we'll take care and we'll talk soon.
Okay, cheers.
Hey guys, it's just me again. Thanks a lot for listening to this episode. I hope you really enjoyed it, and I can tell you for certain that it was a great opportunity to speak with Howard. So thanks again for listening to this discussion. I hope there was a few points that you're going to take away from this. So just a very friendly reminder, if you could, please go to chatwithtraders.com/iTunes and leave a very brief review. Like I mentioned at the beginning, it doesn't have to be anything major. Just a single sentence would be a massive help. And in case you're wondering why I like to ask for reviews, it's because essentially the more reviews that Chat with Traders receives in iTunes, the better the show ranks. And of course, the more listeners that, the more ears we can attract to the show. So if you could, go to chatwithtraders.com/iTunes and leave a very brief review. And for what it's worth, I'd like to thank each and every person who leaves a review. So once you've left a review, shoot me an email and I'll respond with a great big thank you because I really do appreciate it. And my email address is just aaron@chatwithtraders.com. All right, guys, have an awesome week and let's talk very soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade.com/chat for more info. All applicable regulatory exchange broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
What's up, guys? Thanks for tuning in to yet another episode of the Chat with Traders podcast. You're listening in to episode number 36, and I can promise you right now, this one will not disappoint. My guest today is the legendary trader, Peter Brandt. Peter first started trading around 1975, which I'm sure is before many of you listening were even born. I mean, that's certainly the case for me. So that's almost 5 decades involved with markets, a very long time. To give you an idea of Peter's performance during this time, he has achieved a compounding annual growth rate of approximately 42%, with his best year returning well over 600%. Of course, we want to know about his worst years also. Well, there has only been 3 losing years, which were all drawdowns of less than 8%. During this interview, we discussed Peter's early years working at the Chicago Board of Trade and classical charting patterns, which form the roots of his trading methodology. We also get into Peter's views on high-frequency trading operations, why he has the default assumption that every trade will be a losing bet, and some of the common misconceptions about super traders. So you guys are really going to enjoy this one. But before we jump into it, I'd like to tell you about a brand new premium ebook which I've only just released. It's titled Why Most Traders Never Succeed. The reason I decided to create this was because, as we're well aware, most traders consistently lose money and will eventually crash and burn. Some say this accounts for 90% of traders, But I mean, I wouldn't be surprised if the real number is even higher, which is just frightening. I understand the title of this ebook is not overly glamorous, however, that wasn't my intention. Instead, my intention was to create a guide that breaks down why most traders fail so that you're aware of the most common reasons for this. Once you're completely aware of these reasons, then you can better align yourself for success and decrease your chances of becoming another washed up trader. The content within this guide is the curated and polished answers from 18 of the high-performing traders who have featured on this podcast. Also included are additional summaries to add context and to help you understand. In total, this ebook is more than 8,500 words long, and it's just over 40 pages. This guide is $15 and it's available right now at chatwithtraders.com/read. That's READ. Even though this ebook is most likely cheaper than a round trip of trading commissions, I'm offering a full refund if for whatever reason you don't find the content to be valuable. So I'm pretty confident you'll benefit from reading this. So you can purchase this ebook and learn more about it at chatwithtraders.com/read. That's READ. You can also look at a few sample pages by following this link too. All right, guys, let's get into it. I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Peter Brandt. Hey, Peter, welcome to the podcast. How's it going?
It's going well. Thank you very much for asking. It's morning where you are, and getting to be about dinner time where I am. But it's good to be on this program with you. I've listened to a number of your casts, and I've enjoyed them.
Well, thank you very much, Peter. I mean, it's great to be speaking with you. We've been trying to set this up for a little while now, but we're doing it. It's happening. So thank you very much for doing this. I mean, it's an honor to be speaking with you. Now, we've got plenty to get through in this short amount of time today. So obviously, we'll cover your early years as a developing trader. And then we'll get into how you trade and specifically some discussion around chart patterns, which I think will be really interesting. You've got a lot of insight around this topic. So let's kick this off, though, and take us back to where it all started for you. I mean, I understand you first got involved with the markets around about 1975. So tell us how this happened, and also what were you doing prior to this?
Yeah, Aaron, I at the University of Minnesota, and where I was a journalism advertising major, and then right out of college, I was married and had kids, and I was a real young guy, and we moved to Chicago, where I worked for what at the time was one of the 5 or 6 largest advertising agencies in the world in Chicago, and that was a great opportunity. And so I'm in my mid-20s, and a father of one of my son's friends, I met him, and he was a member of the Chicago Board of Trade. I worked downtown, and of course the Chicago Board of Trade was downtown on the river, other side of the downtown. But he invited me to go have lunch with him someday and see what he did for a living. So I went over to the Board of Trade. We had lunch in the members' dining room overlooking the pits, and of course that's back in the days when pit trading was really almost at its peak, and it was just fascinating to me. I was captivated by it. And so I ended up inviting myself for lunch, probably more than he wanted to entertain me, but just was captivated by all of these guys yelling and screaming. I think what interested me the most was the fact that here you had people that didn't sit in meetings all day, were responsible for what they were doing and could determine at the end of the day to the penny how their day was. You talk about direct in a feedback loop. And they were on their own. They're many of them doing their own thing, and I just found that extremely compelling. And it was my interest at that point to find a way to get in the business, and that was back in the infancy, really, of futures. I mean, the modern era of futures trading really back only to about 1970, 71, 72. Prior to that, prices of just about everything had been flat for years, and then we saw some crop failures in the U.S., the Russian grain buying, and we saw price explosions pretty much across the board in 72, 73. So I wasn't really too far past that date, and there was no MBA fast track back then. There probably isn't even today in this business, but everybody started at the bottom, and I just really went around pretty much from door to door at the Board of Trade, trying to find a way to get in. I finally found a company, it was Continental Grain Company, which at the time was the second largest grain merchandiser in the world next to Cargill. And Continental offered me a position, which basically meant I could sit on the edge of the pit, and I had to go find some people to do business. So, literally, they gave me a guaranteed salary for about 6 months, and then it was on my own. And so I kind of went that route. I had some very large institutional business that I generated right away. I'm just past 25 years old, and I knew back then that that's really not what I want. I wanted to learn how to trade. I wanted to trade for my own account, and it was just for me a question of how to do that. And but in the meanwhile, I had to kind of learn the business and make a living for myself, which I was able to do. And it took me about 4 or 5 years, I think, to really become accustomed to the market, to figure out how I wanted to trade, really to develop the capital that I needed to trade. And then in 1980, I went off on my own, left Continental, and started a factor trading company as a proprietary trading firm at the Board of Trade. And I guess, as they say, kind of this history.
Absolutely. No, that's really good, Peter. So I want to just zoom in on something you said there, and that you weren't really a trader while you were working at Continental Grains. So at what point did you feel confident to transition from being an employee there to trading out on your own? Like, where'd you get the experience to trade before you made that jump?
Well, I think in a couple different areas, Aaron. I mean, when you're back in the days of the exchanges, you were in a building with hundreds of other traders, many of them trading for their own account, and found traders pretty willing to share with other people what they do. I mean, some are very private and don't really have much to say, but an awful lot of the good traders out there are willing to at least answer the specific questions you answer them. And I developed some friendships with some very, very proficient traders. And I started no prohibition against me trading my own account, so I'd accumulate a few $1,000s and try to trade it and blow it up. And I don't know how many small accounts I blew up before I finally kind of caught the scent for the approach to markets, which made sense to me, that kind of fit who I was. So would raise $5,000, $6,000, $7,000, fund an account and lose it and do it all over again and have a little more success and do it all over again and have a little bit more success yet. And so I think for me, it was just a question of I had to make enough mistakes, crashed and burned enough times so that I started at least catching on to some themes that contributed to an eventual success as a trader.
Okay, sure. So you mentioned there that you were speaking to people and you'd made some friends with actual traders, guys who were in the pit and, in the trenches trading. Was there anyone who sort of provided maybe further assistance and had more influence on your trading? Maybe like a mentor or someone who provided you with some mentorship during that time, or was a lot of it just things you picked up from speaking to different people?
No, I was really lucky, Aaron. I had a trader, a guy who was a Cargill, who befriended me. Actually, he borrowed my wife and I the money that we used to purchase our first house, put a down payment on our first house. He was a single guy. He'd spend holidays with us. We became very, very dear friends. He's since deceased, but he was as good a trader, I think, as I've known in my lifetime. And he shared an awful lot with me, not necessarily about technique so much as about philosophy, really philosophy of risk management is what he drilled into me. He taught kind of just the practical aspects of surviving until you were successful. And because that's an awful lot of what of I think so many novice traders today try to shortcut the process, and in doing so, they may not ever really build the foundation need to build on, at a future date. And so he was very instrumental, I think, in encouraging me, but he was also just so influential in drilling home to me the importance of risk management, the importance of keeping your capital together, the importance of taking losses quickly.
Okay, and just before we move on that, I've got to ask, because I know that many of the traders who are listening to this podcast are searching for someone like that, someone who is going to guide them with their trading and can be there to answer questions and be a mentor. How did you meet this person? Was it from your connections of working on the Chicago Board of Trade, or did you meet this person in a different way?
No, it was when I was working for Continental, I had gone out, and this was in the age when an awful lot of users of rails were still early in the process of learning how to hedge, and I focused on bringing into Continental some customers that were users, producers of food, and one of those was Campbell Soup Company, another one McDonald's, and in the process we kind of crossed paths because they were the oil seeds, and so we became familiar with each other really down by just seeing each other in the elevator, knowing each other were on the floor from time to time, striking up a conversation, found that we had some other things in common, and kind of a friendship developed, and then a mentorship developed. And I think that those of us who started on exchanges had a real big advantage to so many traders today that start off behind their closed door in their house or in a small office and staring at computer screens all day, in that we were part of community. Trading can be a very, very lonely, especially it is today with the electronic exchanges and people setting up laptops in an office at home and throwing a couple screens on the wall, interact with other traders. Whereas those of us who spent some time at exchanges, whether they be CME or Board of Trade, New York COMEX, whatever, really fellowship in community and sharing in ways that I think were to our advantage.
Absolutely. No, you're totally right there, Peter. During those first few years, which we've kind of briefly talked about, you mentioned that you blew up multiple accounts. What actually led to you blowing up these multiple accounts, and what were some of the greatest challenges that you had to overcome during these first few years?
I think you just have to make mistakes. I think you learn to make mistake after mistake after mistake, trying to figure things out. Learning to trade is really an exercise in problem solving more than anything else. I wasn't sure how I was going to trade. I knew I wanted to trade. That was an assumption. I had certain assumptions going in as to what it would take for me to someday be a trader. A lot of those assumptions ended up being wrong, but I did have those assumptions, and but I wasn't sure how I was trading. So I was looking to other guys that I knew were successful at the Board of Trade at the time. So it might be somebody who traded the markets based on supply and demand, and I'd listen to them and I'd try to trade the way that they traded. Somebody that kept point and figure charts, or somebody that traded spreads, or somebody that traded cycles, or somebody that traded what's called analog year principles. And I think one of those big mistakes that I made was that I could kind of hook my wagon onto somebody else and learn how to trade as they traded. I think it always takes a few years to kind of unlink yourself from that idea and theme, and to figure out that if you're going to trade, you're going to have to do it on your own. You're going to have to make your own mistakes. You're going to have to kind of pick up a scent as to what makes sense to you, what works for you, what doesn't work for you, what time frames work for you, what methodologies work for you, what money management protocols work for you. And so I think it's a process of working through that. And then in doing that, there were some approaches to trading that I tried that just frankly did not make money, that I lost money. But in the process of doing that, I would learn a little bit here and a little bit there. But more importantly, I would learn those approaches to the market that just were not me. And so you can discard those, and you learn a little bit, and you go on. Learning to trade is kind of like going to a university, except you don't get to determine your own tuition. The market kind of gets to decide what tuition you're going to. But it is a process, and I think it's a process that takes most people I know who have become good traders somewhere between 3 and 5 and 7 years to get to where they really feel confident in what they're doing enough to kind of go all in and take a leap of faith and say, this is the way I'm going to trade, and this is what I'm committed to. And it takes a lot of mistakes to get to that point. And it's not something I don't think beginner traders can do quickly. I think those that do and come to a conclusion that they really know what they're doing too quickly will end up paying the ultimate price.
That's a really good answer, Peter. I like how you spilt that out for us. During that time, that process of you learning and you blowing up accounts and going from different approach to different approach, was there ever any moments when you came close to maybe throwing in the towel? You were just like, this is too hard, it's not working, and giving up on the idea of becoming a trader? Or what was it that kept you going?
I think what kept me going is that I had an income stream coming to me by doing business with large commercial customers. And so it wasn't like I rented a seat on the board and walked into the pit and put my life at risk and I had to make it. I did have income, and the income I had from some of these consulting clients was fairly good income for time in history that it was. And so I had, I think, a huge advantage in that I didn't need to be successful right away. I had time to learn it properly. Of course, I'd sock money away and lose it, but nevertheless, I had my eventually when I bought a home, I had my mortgage payment paid. I didn't have to dip into my trading account to pay for car payments or insurance. I can't imagine what that would be like for a new trader to feel the pressure of having to make money to pay for their expenses. That would be a shuddering thought to me. And I know there are a lot of young traders who are doing that, and they feel necessity to trade because that is their source of income. I think that's a very bad place to start off from. So I didn't have that pressure. Bought me time. It could have bought me more time. And so I didn't, during that process, feel like, this was the end of the game and throw in the towel and that's it, because I did have some income flow. I think there were periods once when I started off and it really was, I was dependent upon my own trading activity, although I had money in the bank to pay bills. But there were times then when I felt a little bit more pressure. Some times then where I think it could have gone the other direction. to a certain degree, I look back at some of the trades I made early on, and it scares me to think about the risk I took, because those are trades that might pay, and I might not be talking to you today. And so I think to a certain degree, Providence entered in.
So what would you maybe say to any new trader out there who's perhaps thrown themselves in the deep end and maybe currently relying on trading as their only source of income while they're still learning? What would you maybe say to them might be a more effective way to learn how to trade?
Well, I think they need to go back and get a job, frankly. I mean, it scares me when I hear from some people saying, I'm going to quit a job that's paying X amount of dollars a year, and I've got $100,000 saved up, and I'm going to trade, and I'm going to be successful from the get-go, and learn a little bit as I go, and I think that's a recipe for disaster. I really believe that if somebody, trading can be a wonderful, wonderful hobby for a person who's a lawyer or an accountant or a policeman or whatever the case can be. If they can learn how to trade, they don't have to trade full time. Trading can be a very rewarding thing for them to do on the side. They can become, of course, they can't be day traders, but they can be position traders, which I recommend people be anyway. But they never have to really say, well, this is going to be my career. But for those who feel that is their calling, to be full-time, to become journeymen in the craft, I think they need to have at least 1 year and perhaps 2 years worth of savings in the bank to pay their expenses, their living expenses. And I believe that the capital that they use to trade with should not be capital they inherited or saved up doing up. I think it should be capital that they earned in the markets. Until they've made enough in the markets to support a trading account that is large enough to potentially their source of future revenue, I don't think they should trade. And so I think you trade after you show that you're successful trading, and after you show enough trading that you've accumulated what you need to trade. Then if you want to become a full-time trader and quit a job, you do so with fear. But so that's my view on that, Aaron.
Sure. Okay. No, thank you very much for sharing that. Now, let's fast forward just a few years, and I think it was around the mid-'80s. You had a kind of frightening near-death experience. Would you be able to perhaps share this with us? And also, did this maybe change your outlook or perspective on life and trading in any way, shape, or form?
Well, yeah. I mean, it was August. It was August 26th. I'm right now coming up on an anniversary date, but it was I had always been a sleepwalker as a child, even as a young child, 4, 5, 6 years old, in a neighbor's garage or outside the home or in the basement, whatever the case may be. I had always been very active in my sleep, and at date 1984. I got up out of bed and 2:30 in the morning fell 17 feet to a concrete slab and did my spine. I was in the hospital for 41 days. I was in a full body cast for 5.5 months, and then in another kind of Velcro halo type device for another 4 or 5 months. But I did a number on my spine, and that, of course, is a gift that keeps on giving. But I don't know if it changed my view of trading so much as it took me out of action for a bit. I think it probably changed my view on life a little bit, but not necessarily on trading.
Okay. So in what ways did it maybe adjust your view on life?
Well, I think that recognize there's more to life than turning on your quote machine and keeping charts up and trading. That you've got your store of value that how do you measure yourself? How do you represent yourself? Do you find your worth based on what your account did this month, or do you find your worth in other areas? Markets are all compelling. They're addictive. It's easy for somebody with an obsessive personality to become all involved in the process of market speculation and forget about the fact that there are other things in life that have value, and that we really need to measure our self-worth and who we are.
Sure, absolutely.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Now, Peter, let's move this discussion along a little bit and get into maybe the nuts and bolts of how you trade these days and how you've traded for the X number of years. So, how would you describe your trading style and your methodology for reading markets?
I had in the 70s tried this and tried that, and there was another friend of mine. It wasn't my friend from Cargill. It was another person I had met at the Board of Trade. Told me that he was a classical chartist, to which I said, what's that? And he said, well, come with me, and I'm gonna go buy a. We went across the street on Jackson Boulevard to a little bookstore that was in the block next to the Board of Trade, and he bought me the McGee and Edwards book, and I'm sure most are familiar with that. Which I just consumed. I mean, I read it literally in a weekend. It just all of a sudden made sense to me. I could relate to it. I could see myself trying to trade that way. And of course, Edwards and McGee make mention early in their book that a lot of what they were talking about was based on the original works of Richard W. Schabacker. So I immediately tried to find Schabacker's manuscript. Back then, it wasn't published. You couldn't buy a book. It was a course, and I ended up buying a photocopy company in Los Angeles that had kind of these old manuscripts, and it was really Schabacker that really, in a more pure sense, turned me on to classical charting principles. And so I think that at that point, I became convinced that I would be a classical chartist. It just made sense to me. Now, there were still a lot of things that needed to be out. What do you trade? What's your time frames? What patterns do you look for? How do you draw patterns? I mean, you show a chart to 10 chartists, you'll probably get 15 different views of what the chart has to say to you. So, it's not an art, it's not a science. I think it's a craft. And like any other craft, you kind of move from apprenticeship to journeymanship. And in the process, you have to kind of figure out, yeah, you're a chartist, but what does that mean? How does that play itself out on a day-to-day basis? And I think that's a process. I look at my trading over the years, and I'm aware of the fact that I've tweaked a number of things and continue to do so. But it was interesting. I gave a speech, a plenary address to the Market Technicians Association in '89. And here a year ago or so, one of the MTA members sent me a copy of the speech that I had given in '89. I didn't have a copy. I all about it. And I read through my speech, and it was almost spooky because there really hadn't been a whole lot of changes that I had made to my trading since then. There, money management, a lot of nuances, but for the most part, I've stayed true to the classical charting principles. I think I've become longer term. I used to trade more daily charts, where now I tend to trade more off of weekly charts. I use daily charts for timing, but for me, I look for classical patterns. In particular, I look for patterns that have a horizontal boundary. I do not like diagonal boundaries. I hate trend lines. When I see a chart a slanted line, it freaks me out. I think that's a low probability payout. I want to look for a chart that's got a recognizable chart pattern with defined horizontal boundaries, such as a descending triangle or a rectangle, or head and shoulders pattern. I mean, those are probably three of the patterns that I trade more often than any. I look for patterns that develop over the course of at least 8 weeks. I have no interest in day trading. I want to see patterns that I can recognize on weekly charts, and I found that usually a pattern of 8, 10, 12 weeks on a daily chart will convert on a weekly pattern that you can see. But I'll trade, patterns that go on up to several years in duration. Sometimes these real duration patterns are difficult to trade because the breakouts aren't as precisely identified. You're a little bit more sloppy in how a boundary is drawn. But I certainly am interested when I see a pattern that can be in a considerable period of time in duration. I like those patterns, and then I try to find something on the daily chart which gives me a trigger point. Because when you chart pattern, sometimes you can't be precise as to where exactly that line comes into play, and so that's where charts become important, is trying to find something on the daily chart that gives me a breakout. I'm a momentum trader. I trade breakouts. It's how I trade. I've never really become very good at selling rallies or buying breaks. It's a skill set I wish I had. I don't have it. I know some traders do have it, and that's their preference, and I think that's wonderful. It's just not my deal. My wheelhouse is big patterns and breakouts of big patterns and big. I trade futures and I trade Forex. I trade very few stocks. I do look at stocks. I look at stock indexes globally, but for the most part, I'm in 90% a futures Forex trader. Of that, probably half and half. I like the Forex markets, and of course I from origin am a futures trader, and so that's kind of my stick.
Okay, that's really interesting, Peter. Thanks for sharing that with us. Now you mentioned there like price going through a level of horizontal resistance, or support as a breakout. Have you noticed over the years that these have become a lot less clean cut? You did mention that they, are often sloppy, but did you notice that they have become more so less clean cut over recent years with the advances in technology and, all the rest of it that comes with it, like algorithmic trading systems and that type of thing?
Yeah, I definitely do. I mean, I think charts were more reliable, particularly daily charts, 80s, early 90s. I think that Today, I look at daily charts can get pretty from time to time just because of the volatility. But I address that in a couple different ways. First off, I don't think that we have that degree of added unreliability when we're dealing with weekly and monthly charts. The reason being is that in a lot of these markets, volume is coming in from high frequency trading operations, which of course are, in my opinion, illegal operations that run my orders in advance, know what I'm going to do before I do it. But so that's a large amount of volume that takes place, and those high frequency trading and algorithmic operations are pretty good at knowing where the orders rest, and they're pretty good at running stops, and they're pretty good at creating false breakouts. And so they day-to-day basis is a little bit more difficult to create a false breakout on a weekly chart pattern. But the other thing that I think I've graduated to, I've gradually moved to over the years is more dependence on a closing price. I just find what markets do during the day really doesn't matter much. Jerk themselves around looking for stops during the day. Volatility is created to kind of suck people in. I look at intraday volatility as just simply wealth redistribution, the hands of the many to the hands of the few. And so I really don't want to be pulled into markets based on intraday price volatility. I wait for closing prices, and when we get closing prices, I act accordingly. So I'm looking for closing price breakouts of recognizable patterns through horizontal price boundaries. I think that's another thing that were diagonal patterns such as the boundaries of symmetrical triangles or the violation of trend lines. I think that's an area that has really become more dicey than it used to be. And for that reason, I tend to stay away from chart boundaries that are diagonally on a chart, because I think that's where you get an awful lot of sloppiness.
Okay, that's a great answer. Now, something you said in there which I found really interesting was you mentioned that high frequency trading should be, illegal, or they're running illegal operations in your mind. So, what are your thoughts on that? I'd love to hear you speak more on that topic, on why you feel that way.
Well, I mean, it's a legal issue. Ultimately, it's going to be settled by a legal issue, but I think it's an ethical issue and a moral issue as well. I mean, what we know is that these high frequency trading operations, which are run by high speed computers and built around algorithms to take advantage of certain market situations, are piped into the exchanges. In the case of in Hoboken or in Des Plaines, Illinois, they've got their pipe to the price reporting mechanisms than I do. They get prices a fraction quicker, and as a result, they know prices are trading before I know what prices are trading at. They have an advantage for me, even if it's a split-second advantage. It's being on by a computer that has a microsecond reaction time, and I see it in the way I trade. I'll look at price. I'll look at price columns now, and generally, when I trade, I'm not hesitant about covering the spread, which means I don't mind buying at. I don't mind buying at the offer and selling at the bid. I'll see S&Ps trade maybe 40 contracts offered, 50 contracts bid, whatever. I'll put an order in to at the offer, and I'll click enter, and the offer disappears. Well, it disappears because that computer saw my order going in and adjusted where the offer was. They don't get an awful lot on a percentage basis of their orders filled, even though they represent a high percentage of the total volume in a market. But they have orders, they have bids and offers in the markets all of the time. It's kind of the way they're taking the temperature of the markets. And so I just have an an ethical and moral issue with somebody that's trading on advanced knowledge of price behavior.
Sure. Okay, that's a good answer. I mean, I'm actually really keen to have someone who is involved with high frequency trading on the show at some point to get their views on it all. But I mean, I know a lot of the guys who are involved with that side of trading are, try to keep it under wraps as much as possible. But let's bring this conversation back to chart patterns. So, I'd like to ask you, why do chart patterns even exist? Like, why do specific movements of price occur again and again on pretty much anything that trades?
Well, I mean, there's a couple different ways that I could go to answer that question, and I guess I'll just go right back to Schabacher. What Schabacher's observation is that prices, when plotted and viewed on a price graph, can be seen in the past as either having trended or being in an area of congestion. I mean, I think there's degrees to which that's true, and there's time frames to which that's true. But generally speaking, prices during any given time frame usually either trending or congesting. And in the process of congesting, there is the tendency for prices to form geometric patterns. Now, Schabacher did a really good job in his book, and people interested in this subject further really should read the Schabacher book, because he really kind of goes into what creates these boundary lines. But it is the composite of buying and selling of well, back then it was insiders. When he wrote the book, he is referring to, the groups of the Vanderbilts and so forth that would kind of get together and decide what they were going to do with the market. And so there was collusion, and it was kind of these engineered buying and selling campaigns that would create these areas of support and resistance on a chart, which in turns represented geometry. Where I think today it's, of course, not collusion, but I think that there are trading operatives, there are trading people, there are involved in the markets who are definitely smarter than me. There are people that are operating very shrewdly with in some cases inside information. In some cases, they're just really smart people, and they tend to operate in composite. They don't know each other exists necessarily, but they're acting like-minded. And I think in the process, what happens is that large moves don't normally take place on preparation for that move to take place. That in general, when substantial moves take place, you are under pretty good assumption that the right people have been prepared for that move, have taken positions for that move, and are making money on that move. And it's so during these periods of congestion where big money comes in and creates tops, big money comes in and creates bottom. In the process of creating bottoms, tops, and consolidation areas, we tend to find ourselves with developing geometry. Now, I've got some philosophies of charting that I think some folks will find kind of contradictory to the fact that on charts. I mean, I don't believe that charts are predictive. I don't believe that you can predict any given market at any given time based on the chart patterns. I take real exception to Elliott wave people who tend to think that at any given time they can define where we are in a wave structure, that a wave structure is always viable. Of course, they can be wrong, and they call that revisions of that structure. Well, I'm a trader. I don't call chart patterns that don't work revisions. I call them loss. And so I don't have the luxury of saying, well, I'm revising my opinion. And so I think it's a real danger to always try to understand the market at any given time based on classical charting. But I do think that 2, 3, 4 times a year, we see the type of chart that I'm willing to trade in an individual market. look for it. I don't try to study a chart. I hear people talking about, well, I need to study my charts. Well, I'll take a look at a chart and in 2 seconds know whether there's a trade setting up for me or not. And more often than not, there's not. Most markets, most of the time, cannot be understood based on classical charting principles. And so it's not a function of trying to study a chart until you can figure out what the pattern is. I think there's a pattern or there's not a pattern. And when there's a pattern, there's a possible trade. More often than not, that trade's wrong. I mean, my win rate over time, only 40%, Aaron. And what that means is my default assumption on a trade is I'm going to lose money on it. And so if you take a look and be wrong 60% of the time, I'm only going to be right 40% of the time. From the starting gate, that says chart patterns that are even well defined are not real reliable, at least in terms of the way that I approach it from a risk reward point of view.
Now that was a really great answer there, Peter. Thank you very much for going right into that. That was awesome. One of the things you mentioned at the start there was people should read, I'm probably going to butcher his name, was it Schubacher? Schabacher.
Yeah, Richard W. Schabacher. And the name of his book, and they can find it on Amazon, is Technical Analysis and Market Profits, Profits, and allude to that book in their technical analysis of stock trends is the basis upon which they wrote. And Schabacher, and I suppose but Schabacher really formalized classical charting principles for the first time.
Okay, sure. All right, well, I'll put a link to that book in the show notes if anyone wants to check that out. All right, so let's keep this moving. Would you be able to give us just a brief overview of how you generally actually manage trades? Once you've identified a pattern and you've taken a position on that trade, how do you then go about managing this in regards to stops? I mean, do you use trailing stops or do you have profit targets in place? What's the next step after you're into a position?
Well, now it gets kind of complicated, but I can try to answer that question. It's not an easy one to answer. I have a lot of nuanced ways to do it, but let me approach it from a little different angle. If each trade would have taken since the inception of factor trading in 1980 were to be printed out on a sheet of paper as statement. We used to get those by the mail. Now some brokerage firms still offer it by mail, but most of them come over the computer. But we used to get statements for every we do. And if I would have accumulated over the years a statement for every trade that I would have done and piled them on top of each other, I don't know. I made that I'd probably have a stack of paper that's probably 8 to 10 feet tall. I've made literally thousands of trades over the years. I know as a trader what my net bottom line as a trader over the years is. I mean, that's a pretty easy number for me to come by. I just need to run a cum of my tax report, what I've paid the federal government. So I know what I've made as a trader over the years. Now, if I were to start picking out of that pile of P&Ss, starting with the largest profits and then going down in that order, and pulling out pieces of paper until I come to an amount that equals my total performance as a trader since inception, I probably only end up with about 10 to 15% of the total trades. So, 10% of producing 90% of the profits, or 15 producing 85, whatever the case may be. Now, if I had to go a step further and say, I'm going to study those trades, I'm going to look at the trades that were I call my net bottom liners, the trades that really produced for me my trading profits over the years, that 10, 15, 20% of the trades that I made money on. was there anything unique about those trades? And it quickly becomes apparent that there is. They tend to be trades that work right away, and they never look back. They break out and they don't hesitate. I mean, that doesn't mean to say that, I've got a huge profit at the end of day 1 or 2 or 3, but it's at least not a trade that puts me into trouble. The person I mentioned who had the biggest influence in my life, the guy that traded for Cargill, he had a trading rule that he drilled into me, and that is you never take a loss home on a Friday. If you've got a loss in a position on a Friday, you get out of it. Without any question whatsoever, you get out of a trade. And he even took it a step further and further trading this. He didn't like taking any trades home that were losers on any given night. And he was a position trader. He wasn't a day trader. He'd take position an extensive period of time, but he placed a lot of emphasis on timing. And if your timing's not right, your trade's not right. To be successful, a trade has to be right on direction and it has to be right on timing. And if a trade is not right on both of those things, it's not a trade I want to be in. And so I tend to play markets pretty. I generally risk, 1% or less of my trading capital, my nominal trading capital on a given trade. And I will markets with pretty close stops. I trade multiple contracts positions, and I tend to treat an entire position with different trading rules. I will take half of the position and I'll tend to trade it. I'll tend to take profits and look for an opportunity to put it back on. So if it's a short position, I will try to find opportunities to buy the breaks and then sell some sort of rally. And then I'll try to hold half of a position for as long as I can. And that's 3, 4, or 5 weeks. In some cases, there was a trade I did last year. There was a Forex trade in the dollar against the Singapore dollar that I held for, I don't know, it was 4 or 5 months. And so as long as a market is going in my direction, as long as I have a feel that it has further to go, as long as it doesn't start struggling, I'll tend to stay with the trade. But I do not use trailing stops. I think I'm kind of opposed to that, frankly, is you say, well, I'm going to, when I have $500 made, I'll move my trailing stop $250 below it, and I'll keep a stop from a trade. That to me it really doesn't make sense, because what happens is based on what a market's doing on the hopes that the markets will take care of the bias. When I'm optimistic about what the trade's going to do, but I have no control over what a market's going to do. The only control I have is over the that I enter. People try to glamorize the business of being a trader. Being a trader, at least being a position trader like I am, is actually a pretty boring job. I mean, my job is basically that of a glorified order enterer. I want to make sure that the order makes sense based on the chart that I'm looking at. I want to make sure that my position size and my money management makes sense based on my capital. And it is on the order that I enter. Is the order that I'm entering this evening, are those orders make sense? Will I be able to look at a chart 6 months from now and have every entry I make and every exit I make sense looking back a year or 6 months after the fact? The reality caught up in markets the way that everybody does. I do stupid things. I mean, I still do stupid things. I don't know if I'll ever be able to purge myself of stupidity. But we don't seek perfection, progress. And so as long as I pull myself back, try to stay distant from the emotions of volatility during the day, and have my focus be entering orders that make sense based on my approach to the markets, then I'll let profits take care of themselves.
All right, sure. Now, Peter, many traders look up to you, especially for your extraordinary returns which you've accumulated over the years. But what's probably just as impressive, if not more so, is how you were able to achieve these returns with only very minor drawdowns. So I'd like to ask you, what are some of the common and perhaps dangerous mistakes often made by novice traders around risk management?
Well, I mean, I think there's a lot of them. I'm not a day trader, so I can't speak to the dangers of day trading. I'm sure those people are provisioned from different answer to this question than somebody that tends to be a position swing trader. I'd say I'm kind of mid-range between a swing trader and a position trader, and everybody's going to place a different definition on those terms. I mean, so for me, what's a swing trader is going to be different than what somebody else defines as a swing trader. But I think the big one is just making sure that whatever your approach is going to be in style with the market, in sync with the markets at times, and at other times sync with the markets. I don't want to have to get myself in a position where I have to change the way I'm trading all the time just because the markets, I perceive the markets as trading. It's the markets are trading, so I'll pull plan B out of the closet. I've got a plan A. That's what I exercise is my plan A. And I just assume that plan A will be in vogue in step times and out of step with the markets and times. And it's what happens during the out of step phases that really make the difference in the end. Trading is a marathon. It's not a sprint. It's for me, it's a long-term thing. I've traded now in 5 different decades. In 5 more years, I'll be able to say that I've traded in 6 different decades. And so my goal is to keep my capital together when I'm in a losing streak. And that pulling back size when I start losing on my trades. It's when I feel that the markets are not as well definable as they have to be. It's pairing my size, it's paring back my risk. It's at times saying I'm going to be more picky on the signal that I'm looking at, and it's by very careful. It's it's diligence. If you exercise diligence, the rest is in the details, and it's by trying to just be diligent to keep my together. If you trade long enough, particularly in leverage markets like I trade. Sooner or later, you're going to make money. I mean, you can't help it. If you trade long enough, make money. It's not the making of the money, which is the real challenge. It's the keeping of the money that you made. And I have just found that traders that over the long pull have records that I admire are traders that tend not just necessarily to be the best at selecting trade. I think trade identification. Trade signaling is grossly overestimated in its importance. That money management and keeping the capital of an account intact, that's where a trader needs to spend their money management side, not on the trade identification side. I think novice traders in particular place way more emphasis on trade identification than they should. The emphasis needs to be placed on risk management, money management, and on the process of trading, on being repetitive. I'm also a pilot, so I know what checklists are. As you get into a plane and you do the same things every time you're in a plane, you go through your checklist. You purposely look at thing. You have a written checklist and you check this and you check that and you go down through your checklist and you're very purposeful in how you go about piloting that plane. I think a lot of traders get sloppy with how they trade, and that's when they get themselves into trouble.
Okay. Now, Peter, we should probably start moving towards the later part of this interview and start to wind things down, but I've got 2 more questions that I'm really keen to ask you. So the first one of those would be, what are some common misconceptions that people often have about traders who quote unquote make it?
I think a lot of people listening to this will probably disagree with me on this answer, but I feel strongly about it. I think my going in assumptions when I first went to the Board of Trade was that I would become a successful trader because, I felt I was just as smart as some of the guys that were down there. I would work hard. I would be studious, and I'd put in a lot of effort, and that those things would bring me results. And I'm not discounting those things. I'm not discounting intelligence. I'm not discounting hard work. I think they play a factor, but there's this thing that comes into bear called providence. I look back, and maybe if I would have started at a different time, I might not have had the in trading that I have had. Maybe if I would have had different people who would have come around me, call it luck, call it providence, call it destiny, call it whatever you want to call it. Providence, call it destiny, call it whatever you want to call it. But that, my outcome wasn't necessarily based on, what I perceive.
I think that's brilliant. And
becoming right on a trade, becoming right on the series, I get personal. Hey, you're going to be wrong on a lot of trades. I just see that in so many traders. They're afraid to put on a trade because they're afraid the trade's not going to be right. That they're going to be wrong on the trade. Well, I don't have any problems with being wrong on the trade. I just assume I'm going to be wrong on the trade. As my default position is I'm going to be wrong on the trade. And if your assumption is you're going to be wrong on the trade, you approach money management differently. And so I think that's one reason. I think if there's a second, they trade too big. They oversize their position. They trade too much. They're too aggressive in trying to build a position that's larger than their account can support. That's particularly true, I think, in Forex and futures, not so much in cash, especially in stocks with a cash account or even a margin account. You're reined in based on what your capital is. You run out of your capital pretty soon. You don't, in the case of futures and Forex, seldom do I have more than 15% of my capital committed to margin. And so they come into futures and they say, my goodness, the margin on a contract of beans is $3,000 and I have $30,000 in my account. I think I'll do 10 contracts. Well, I do one contract of beans for every 100,000 in my account, or 10 per million. When I tell novice traders that, they at how small a size that I trade. And so I think the mistake a lot of novice aspiring future traders make is they trade way too large a size.
Okay, great answer. Pete, what an amazing interview. Thank you so much for doing this. I mean, it's been an honor to have the opportunity to speak with a trading legend like yourself. Thank you so much for doing this.
You bet. Thanks for doing this. What you're doing, Aaron, is akin to what my friend Jack Schwager did in the form of books, is supply to new traders as well as old traders, just stories about unique things. When I listen to your interviews or I read Jack's book, there's a couple of things that stand out. That is, every successful trader finds their own way. They find their own route. And it's only when they take responsibility for themselves do they really start to achieve and own it. And the second thing is the emphasis they place on money management, the strict emphasis on money management. I think those are two commonalities that you'll find us good traders and across continents.
Yeah, for sure. Those two things are very prominent. I mean, even I've picked up from having interviewed, what are we up to now? I think this will be episode 36. So, yeah, I mean, both really good points, and thank you for highlighting those. Now, Peter, where can listeners go to find out more about you?
I do tweet. At Peter L. Brandt is my handle. And then periodically I'll post a blog, and that's peterlbrandt.com. I'll put a blog up. I don't blog as much as I used to, mainly because I find WordPress difficult to use, but easier sending a tweet. So, if they want to kind of see what I have to say from time to time, I will say this. I have a philosophy that I trade by. It can be summed up this way: strong opinions, weakly held. When I get into a trade, I have a strong opinion on it. But the minute that trade turns against me, that opinion all of a sudden becomes weakly held. And so sometimes I get some grief on Twitter because I'll express a strong opinion in a market, and then 3 months later they'll come back at me and point out how wrong I was. And what they don't realize is I was probably out of the trade the next day, because I have strong opinions weakly held. But and so I find Twitter is kind of a engaging thing to do. But I think when you have a public presence like I do, you get your of who like you, but you also get your followers who want to find every fault you make.
Yeah, yeah. I mean, I guess that's just part of what we're dealing with at the moment now, with the social media the way it is. But yeah, I mean, I suggest everyone goes and follows you on Twitter. I mean, you post a lot of charts, which I find really interesting to look at. So yeah, a lot of value just from following your Twitter page. Also check out your website, which I'll link to in the show notes. What is your website again, Peter?
It's peterlbrandt.com.
.com. Okay, excellent. I was actually on your site the other day, and I think it might have been the About page. You've got 11, I think it was 11 trading rules, which I thought were excellent, and I'm going to link to those in the show notes. So if anyone wants to read those, go to chatwithtraders.com/36, and you'll find a direct link to those rules that Peter has, his Twitter profile, website, and everything else that we've discussed over the last hour or so. So, Peter, once again, thank you very much. Take care, and let's talk soon.
My privilege. Thank you, Aaron.
What's up, team? It's just me again. Hope you thoroughly enjoyed this week's interview. I can tell you it was a massive honor to have the opportunity to speak with Peter. I mean, he's a guy who's been trading for 5 decades, which is phenomenal. It's such an achievement. Now, just a quick reminder before we wrap things up here, the latest ebook, Why Most Traders Never Succeed, is online and available now at chatwithtraders.com/read, READ. And like I mentioned earlier, I believe there really is huge value to understanding why most traders fail, probably more so than reading a book about how to succeed as a trader, because by now you've probably already discovered there are landmines everywhere. But if you can stay alive long enough, you'll find a way to succeed. The problem is, most traders never make it through the initial learning phase, and it's due to a number of reasons. These are documented in this ebook. All the reasons provided have come directly from 18 of the pro traders who have featured on this podcast in the past. You'll also find summaries throughout to make things very clear and to help you better understand. If you do decide to purchase this, I really appreciate it. It supports the podcast in a huge way, so thank you very much. So if you'd like to find out more about this ebook, just go to chatwithtraders.com/read, READ. You can purchase it there for just $15, and you'll also be able to preview just a couple pages. If you scroll down to the bottom, you'll see a link there in the FAQs, so make sure to check that out. All right, guys, have an awesome week, and let's talk soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard, discipline selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com, NFA and SIPC.
The Big
Chat with Traders podcast. It's great to have you with me, and thank you very much for tuning in. This week, I had the pleasure of speaking to another brilliant trader who has been heavily requested. His name is Morad, but many know him best as Futures Trader 71 or FT for short. To give you just the 30-second rundown, FT has been an active trader since 2000 when he started out scalping Nasdaq stocks. A few years in, he made the transition to trading futures and later started his own proprietary trading firm where he funded and mentored a team of traders. These days, FT runs a brokerage where he provides continuous education and risk control to a structured community, and of course, he remains an active futures trader with a great focus on reading market profile and volume profile, which we get into in great depth during this interview. We also speak about how you yourself can find a statistical edge without the need to be a programmer or have any knowledge in that field. And guys, all the show notes for this episode can be found at chatwithtraders.com/37. So a full recap on this week's episode, any of the links, resources, etc. that are mentioned can all be found there. And just while you're listening, I'd love it if you could please leave a brief review on the podcast in iTunes. This helps in such a huge way to increase the rankings and reach more listeners. So if you could do this, I'd be super grateful. Just go to chatwithtraders.com/iTunes. All right, now for this week's interview, I'm your host, Aaron Fifield, and here is my guest, Futures Trader 71. FT, what's up, man? Thank you very much for coming on the podcast. How are you doing today?
Good. Thanks for having me on.
No trouble at all. I mean, I've had many requests to bring you on the show, so it's really great to have you here. Now, let's get this started like we normally do by taking it right back to when you first got into markets. So tell us, how did you first discover trading and what were you doing prior to this?
Okay, so back in 2000, I was in construction. I was a construction manager. I have a degree in engineering with a minor in economics. And I was working for the largest construction contractor in the U.S. I learned to meditate just a couple years before that. And on a weekend, Memorial Day, I believe in 2000, I went on a retreat. I was living in Florida, drove up to a retreat and a meditation retreat. And I met a guy who was a trader. As we were talking, the markets, the conversation about the markets being as it was 2000, and the crash had just happened, 2 months prior. We were talking about the markets, and he said that he trades equities. He was part of a group known as the SOES Bandits, SOES, and he, based on our conversation, he said, "Hey, I think you've got the right personality for this. You should check it out." I guess I'd complained about my job, the hours and the problems with labor and equipment and all that stuff. And he said, "You really should look at this." And so I thought, yeah, maybe. I was already investing. I was on motleyfool.com a lot, and I was an IBD subscriber, and I was kind of running some money. I was doing that through college as well. But this was trading, which was a full-time thing. So once the weekend was over, I went back to work and I requested to have the following Friday off. And I drove from Miami up to a town called Vero Beach, which is just north of West Palm Beach, and basically joined this guy in the morning. And he said, the market opens at 9:30. I trade intensely from 9:30 till about 10:30 or 11. So why don't you come around, 10:45, and I could show you what we're doing as a group, and you can give me your thoughts on it. So I arrived on time. I sat down quietly. He said, "Just don't say a word." And it was a room. It was sort of an arcade that he created with a group of people. It was a room full of traders, and for the first time in my life, I see guys with multiple monitors on their desktop and so forth. Remember 2000, that's when LCDs started coming out. And it just looked really impressive. And as I sit there, I see this guy just clicking away on his keyboard. And I look at his P&L, and it was like $18,700. And And so I thought maybe that's just his buying power or the account value or something. And then he gets done, and we go out to lunch. And I said, I know this is private, but it says you're up $18,700. Is that a real number? He says, no, that's not. Actually, that's not the correct number. You have to deduct commissions from it. And that blew me away. He said he had traded several million shares that morning to generate that much revenue, and he probably owed about $5,000 in commissions and fees. And it just shocked me to see that he had made, in an hour and a half of trading, what I would normally make at my normal job over, a couple months. And so I was, initially, just like everyone else, I was hooked by the earning potential and so forth. But, as time went on, I learned that that's not what it's about. I basically put in my notice the following week. Took them 2 months to find a replacement for me because I was a project manager, and it would be very difficult to just hand the reins over in a 2-week notice on a $40 million project that I was assigned to in Miami. And it took 2 months, and by then I was ready to move. I set up my account, and that's when I started. So I quit the salaried, regular employment world, and I joined the cowboy world of trading, or that's what it seemed like at the time. So that's how I got my start.
That's an excellent story. So, I mean, that's a pretty bold move to quit your job so quickly, after experiencing what you did. I mean, what was your thoughts behind that? I mean, were you worried that trading was gonna be difficult and that you might not pick it up right away? Like, how did you plan on supporting yourself?
So one of the conditions, the guy who introduced me to this is an extremely close friend to this day. One of the conditions was that I would need to read a couple of books before I started. He said, just wait, read the books, don't quit your job, and then decide if this is for you, and then quit your job. I didn't listen to him because, being an arrogant, pup, I knew what I needed to do, and I just quit my job the next week. But, I read The Disciplined Trader by Mark Douglas, and I picked up a couple of other books, and it just seemed to me like I didn't have a choice, because I was doing work that I didn't like doing, and I knew I needed to make a change, and I knew that I was in the best position I could be in the business that I was in. I was highly paid for my age. I was one of the highest paid people in my age bracket in a company that's been around for 115 years, a construction company. I was well taken care of. I had stock options, which I cashed to open my account for $50,000. And I was, I had a cushion, and I figured because of the projects that I was on and the tenure that I had, if I spent 2 years and failed at trading, that it wouldn't be an end all for me to get back into the construction business, which is always, there's always work, always something to be built. So to me, it was. And this is the case with my personality and with pretty much everything that I do. It's you're either going to dive in all in, or you don't. And so I wasn't going to do that transitional thing where, I'll go to work at 10 a.m. and trade the market from 8 a.m. to 10 a.m. type of thing. I was either going to do it and figure out that I'm no good at it, or not do it. And so it wasn't a big issue for me to quit my job and just pursue it, because I had the means to do that. I had the savings and so on to be able to just leave and go do it. The pain that followed, though, probably, gave me a lot of self-doubt, but it was definitely worth it.
Sure. Okay. Well, let's get into that pain and self-doubt. So you've quit your job. What was the next step from there? Like, what was your experience like for the early years?
This is going to sound all too familiar probably to your audience, but basically I had the best possible environment to become a trader. And I've always traded in a professional environment. So I was surrounded by guys who, I'll give you an example. The last guy before me who joined this group, on his best day, he made over $90,000 in one day. The guy who brought me into the group, his best day was $280,000 in one day. I was in good hands. But in trading, being in good hands it helps. I was in a room that was very focused. There were blinds on the windows, even though we're in sunny Florida. There was a news feed that was running all day long. There was an S&P pit squawk that was running all day long. There was multiple LCDs with CNBC and Bloomberg on them. There was a Bloomberg terminal. And I was with these traders that just came in and absolutely obliterated the market every day, it seemed. But that's not enough. That's not enough, because coming in, watching someone trade, it's kind of like watching Federer play tennis. It just looks so easy, Oh, he just has to run and hit the ball. That's all he's got to do. But try returning a serve from a professional tennis player. Good luck with that. So over the next few months, I basically discovered that I neither had the right attitude, nor did I know myself enough, and that's the hard part, to be able to extract any sort of profits out of the market. So I opened a $50,000 account. And I traded equities. I started with the slower products, Dell, JDSU, and so forth. This was NASDAQ equities. And, the idea was to trade a 50-share lot and to make, $20, $30 a day at the beginning, and then to increase your size and so forth. I basically did not make money for the first, I think it was about 3 months. I just consistently lost every day. And this is trading from, the time the market opens till the time it closes. So it's pretty intense to sit there all day, just fearful that you might hit the wrong key on the keyboard and do something that would, destroy your account. In the meantime, I heard guys yelling, breaking keyboards, rejoicing for the profits that they just made, or you just got there was a lot of input. And this contrasts this with some of the folks that I know now who trade online, who are sitting in their basement, in a quiet environment. Maybe they're a part of a chat room, and it's just a very sterile sort of environment where you're not getting all that feedback. The room I was in, people would yell out things all the time. The bid's thickening up on, Cisco. Take a look at Cisco. Or I'm getting short 20,000 shares here. Looks like the offer's not moving down. I'm out. I'm scratching this trade. Damn it. That sort of stuff. These guys are just constantly talking. And I was the guy in the corner with one monitor, because that's all I could afford at the time. And just sitting there and trying to figure out, what are they talking about? What is an offer? This was not a prop shop, but it was a professional environment. People wanted to help out when they could. And that's a huge thing, that some of the guys were leaving with $5,000, $6,000, $10,000, $20,000 winning days. And I'm just losing $500 a day. And I'm watching my account go from 50,000 to, 20,000 to 40,000 to 35,000 to 32,000 to 28,000, and it just seemed like there was no end in sight. And the more pain, the more fear there was, and the more hesitation there was, and the more losses there were. It's just this cycle that somehow had to be broken. And all you could do about it is just show up, turn on your monitor, sit down, watch the market. It's all you could do. Just sit there. I read a bunch of books and all that stuff, and it all sounds great when you're reading a book. Oh, okay, yeah. So all I have to do is be aware of my fear, Or all I have to do is look at this moving average. Nonsense. You just had to reprogram your instincts because we were trading order flow and we were doing it in high volume and high speed manually. And you just had to be in the flow of the market. It's much like, surfing. You can talk about when you should jump on your board and when you should paddle and what part of the wave you should be in and how to ride a wave. You could talk about it all day long, but unless you're out in the ocean, floating around, waiting for the next wave and falling off your board with every wave and learning, muscle memory and teaching yourself that, you're not going to make it. And you certainly can't learn to surf while you're sitting on Lake Michigan in Chicago, where there are no waves. You had to be in the middle of where everybody else is, and I was, and that's the saving grace. I think that's the key element that helped me see that there is, yes, you can do this for a career because there are people there. I had that hope, and I didn't need that much hope because I could see that these guys were making money. It can be done. It's me. Something's wrong with me. It's not the market. It's not my equipment. It's nothing. It's my head. And that made the transition or the turn come a lot sooner because I had continuous evidence that this can be done, whether it's a slow day or a trend day or a fast day. It didn't matter. Somebody somewhere was making money, and somebody somewhere was losing money as well. I was one of the folks losing money. I hope that answers your question.
Absolutely. No, that was an awesome answer. So would you say that after those initial 3 months of trading, did you start to gain some consistency, or how long did it take you before you were consistently profitable as such?
So I will define consistently profitable not as a dollar amount or metric. I will define it because I had to actually learn to trade twice in my career. 3 times, actually. One as a SOS equity bandit, as a SOS scalper, when they had fractions and then moved to decimals. Then I had to relearn to become a trader when I moved to Chicago and started trading futures, which is what I trade now, as an order flow, high volume scalper, meaning, regularly trading 3,000 round turns a day, something in that volume. And then I had to relearn to trade the market the way I do now, which is more structure, more a stronger position, and more methodical, slower. And I could tell you that consistency should be defined, in my opinion, as the confident that I'll do what I'm supposed to do and that I'll walk away and I'll be rewarded for that. And I would say it took 3 months during my equity days, like my first exposure to trading. It took 3 months for me to stop bleeding. It took about a month of me just floating around, making a little bit and losing a little bit. And then something happened about the 5th or so month where I could confidently come in and say, yeah, I'm okay making $100 today. I think I could do it. I think I'll have at least a couple of opportunities to do that today. And that was, around the 5th, 6th month. And then once you're there and you string together a bunch of days where you